Greetings, Professor McKee here with our next episode for Seminar Saturdays. And today's paper is about options trading and if a ban from 1936 had any positive or negative effects on U.S. futures markets. So the paper is called Does Options Trading Matter for Risk Management? Insights from the 1936 Option Ban on U.S. Future Markets. This paper is by Fiona Hoellmann and Elissa Iorgulescu. I'm sure I mangled that person's name. Apologies for that. And they are both at University of Munster. This was a paper presented at AFA back in January. So a few notes before we start. As you might notice from the title of the paper, this paper uses a natural experiment, but a very old one from 1936. It's pretty interesting that we are able to look at things so far back in the past. And this was a regulatory ban on certain types of options that you could be traded. It was debated for many decades before people finally pulled the trigger. So hopefully people either had decided that it wasn't actually going to happen because it had taken so long before anyone actually did anything. But that's always the potential problem with kind of a law change like this. People might have anticipated it. The fact that it took so long actually kind of helps make the argument that it was less than likely to be anticipated. But they also have very interesting data because they're drawing on data from the early 20th century. So they have weekly futures prices from London, which is what they're going to use as the control. And they compare those with weekly prices from Chicago, which is what is receiving the ban. And they're collecting this from archived sources. As I looked at some of their other working papers, they have a bunch of papers that they're using this data on. I'm not surprised. This is a great data set that they have access to. And they have two interesting results where they're looking at both market volatility, what happens with volatility when we do bans, and what happens with hedging effectiveness. There's a difference here in what happens. One of them is short-lived, one of them is quite permanent. And the difference there is pretty interesting. So, on June 15th, 1936, the United States banned all commodity trading for options at the Chicago Board of Trade. This ban remained in place for nearly 50 years. And this paper is asking, well, when we banned this, did that create problems for the markets? We kind of would traditionally in finance say, yeah, if you ban these products, it's going to make things worse. Now we can kind of test it because there's a different market over in London where commodity options weren't banned. And why might options or other derivatives actually be good? Well, they often get a bad rep because they're used for speculation, but there's a lot of risk management and information purposes here too. So having options allows traders to hedge their risk. They can set a minimum selling price. If you are trying to sell the product, you can set maximum purchase prices using the call options. There's a lot of flexibility that call options and put options add that a mere futures market cannot also fully replicate. And also these options are attracting traders, hopefully informed traders, which will help futures prices incorporate new information more quickly and accurately. That's generally what happens when we have better information. The market just functions better and responds more quickly. So those are the two things they're looking at. How quickly are prices incorporating information following this ban? How well is the market actually doing hedging? So they have basically two hypotheses that they're going to be looking at. Active options trading is going to be reducing price volatility. So if you ban it, volatility goes up. And secondly, active options trading also helps improve your ability to hedge. Your hedging effectiveness improves. And so if you ban it again, it's going to degrade your ability to hedge. They're going to look at something called a hedge ratio, which is something you use in derivatives to see just how effective our futures are at actually hedging the underlying asset. And so both of these hypotheses are operating with the same mechanism. These options were adding value. And now that we've taken them away, it's hurt the futures market that was running in conjunction with that options market. So why did this ban happen? Well, in the early 19th and 20th centuries, so way back, US commodity markets had basically no regulation. There was a lot of market manipulation going on that has been documented. And in response to that sort of speculation, there was a lot of populist movements that was upset about how the price of grain, was all grain futures at this point, was causing problems. So there was anti-option bills that were being proposed for decades, starting in the late 1800s through 1920s. But then the Great Depression happened. And so in the early 1930s, someone again tried to manipulate the market. And, well, there was an impetus to actually take on that ban, which happened in 1936, so a number of years into the Great Depression. Meanwhile, in London, there were prohibition attempts, but they thought options were valuable for liquidity, which is a big part of why options are adding value to the market. And so options remained illegal through the entire length of time. For London, they were banned in Chicago. And so that's the divergence that authors are going to use. And as I said, there was a manipulation attempt that happened in 1933. Someone tried to, or a group of people tried to corner the market, and futures prices went crazy. There was a big investigation in, and well, things took a while. It took 3 years, but they eventually banned options trading. You can still do futures trading, but you can't do call and put options there. They weren't called call and puts at that point because we're back in the 1930s, but they were effectively very similar. They were called privileges, and they were privately negotiated, not standardized on an exchange like a modern option. But there's a call privilege. You can buy the grain at a fixed price. There's a put privilege. You can sell it at a fixed price. And these are very short-term duration. So 1 day, a few weeks at most. So this was very short-term trading going on. Now, how do they get the data on what happened with the futures markets after this option ban? Well, they have data from Chicago Board of Trade from 1934 to 1939 from their statistical bulletins. They hand collect those. And for the London markets, also on wheat and corn, 1934 through 1939, they use the Times newspaper. Again, this is pretty novel in terms of data availability. Like, this historical data is hard to collect, requires working with archives, but they have it now. And so they've got almost 300 weekly observations using the Friday closing price for each week. And right in the middle of their data collection, 1936, is when that ban happens. Oh, and of course, they have to do some conversions because people don't use the same currencies in London and in Chicago. So they taking shillings, pence, making sure that price per bushel of wheat is consistent across our two markets here. They do here's some summary statistics. And they're mostly looking at two different measures for volatility. So a rolling window of the past 5 weeks for standard deviation. And then the Garch 1-1 volatility. I won't go into the Garch type measures there, but these are both trying to capture volatility in the futures prices. So they look at a regression where we have volatility. We have the ban on the Chicago market versus the London market. And the coefficient on ban is going to be what we're looking at. They have a number of controls: exchange fixed effects, time fixed effects. They're looking at both wheat and corn futures. So there's commodity fixed effects. They have a number of controls added as well. And when you're doing discount difference and difference, ideally you can show parallel trends. Hard to prove it, but they have some visual evidence for that. They try to argue that this was not anticipated. People had no reason to expect that this would happen specifically in 1936. There's been a lot of talk about banning and attempts, but it had failed a lot. So plausibly, people would have expected it to not have worked. Maybe that's probably one of the weaker parts for their argument. And there's no spillovers here. Back in the 1930s, transatlantic trade was a bit difficult. Going from London to Chicago and taking advantage of arbitrage opportunities would be pretty difficult, because you got to hop on a boat and go across to do that, and it would take quite a few weeks. So travel time really kind of localizes both markets. So here's what they show for parallel trends before that dotted line. The red is Chicago, blue is London. They look pretty similar. It's hard to say, and there's definitely a huge spike in Chicago corn futures right after that dotted line. It's not nearly as prevalent for wheat, but it's very dramatic for those corn futures, and it's not nearly as pronounced as it is with the blue line. So kind of a nice graph for them. And here's a graph of the Garch volatility, showing similar thing there. The second thing they look at is the hedge ratio, so how effectively the futures are able to hedge the underlying asset, in this case corn and wheat. And again, they're looking at the band, seeing that treatment effect, how the change in hedge effectiveness, what happens to that hedge effectiveness after you implement that ban. So what do they find? Well, with these volatility measures, treatment and after the treatment, volatility is going up. It goes up in 1936. It goes up if you look at 1935 through 1937. And they have a variety of different models that they're looking at for that. These are quite strong statistically. And over that 6-month window or 1 year or 18-month window, you're seeing an increase in volatility. So that is confirmation for their first hypothesis. Options were helping stabilize future prices. And so when you remove them, future prices volatility goes up. This is generally bad for everyone who's participating in the futures market. They would prefer not to have lots of additional volatility. Funnily enough, the ban is probably intended to prevent volatility, and it actually resulted in a short-term increase in volatility. Now, in the long run, they actually find that there's no change. So if they expand out all the way from 1934 to 1939, or 1934 and 1938, so they have extra years, the treatment effect disappears. You can see there's no stars there. So eventually volatility comes back down. The market adjusts for the loss of the options, and things go back to normal. It took several years, so there's a significant amount of time where things were hectic and therefore bad for people trying to trade in the commodities market, but eventually the market was able to adjust. So volatility spiked, but it was temporary. The market was able to find alternate ways to stabilize the price. It did take time, so there's a real cost to doing this, but it wasn't a permanent problem. Hedging effectiveness, on the other hand, can D times the change in FT going down. So hedging effectiveness also declines. And this is again a negative effect of this ban. If you're trying to hedge your exposure to corn or wheat on the futures market, you're less able to do it because those futures are no longer as effective at hedging that underlying asset. So without the options market, the futures market is not able to incorporate information as well and reduces its value in hedging, which is one of the primary purposes of having these future markets, is your ability to hedge. And it continues. They look at both pre-ban, post-ban by splitting the sample. percentage-wise, it's a very large decline. The hedge ratio really went down, 0.43 versus 0.179. Pretty large decrease in your hedge ratio there. So it's not a small amount of reduction in your ability to hedge. Like there's really large problems if you're trying to use the futures market for hedging. And what they find is that unlike the volatility, this doesn't disappear if you expand out 3 or 4 years. Like it's still there 3 or 4 years later after this ban. So it's a much more permanent reduction in your ability to hedge. Now, why would this happen? I mean, we have kind of the overall theory of, well, options are good, we got rid of them, bad things happen. But why would losing options result in problems? So they draw on some theory from a 1998 paper where we have incomplete markets, we have asymmetric information, and we have traders that are informed and also traders that are not informed. When we lose options, the informed traders lose their instrument, their market makers face problems, and then informed and uninformed trades become more difficult to distinguish between. And all these result in more volatility. They also result in problems in that hedge ratio. And the reason the options were useful is because they had more leverage. Options have leverage on more than futures. And so informed traders are less able to move prices when they know things. The market makers are now being forced to increase those bid-ask spreads, which increases volatility and makes it more difficult to have a hedge because they don't know who's the informed versus uninformed traders anymore. And everything piles into the futures market because the option market doesn't exist. And so things are swamped by much, much larger volumes than we normally had. So those are the channels that they link to, say, volatility in theory. Why did volatility recover and hedging did not? Well, there's a few offsetting things. So the market volume increases a lot because everyone piles in. And that actually reduces bid-ask spreads because we have a much larger volume of trades going on. So market gets more efficient and it's going to attract more traders in. So eventually things will stabilize because the market's gotten a lot bigger. Information efficiency isn't not going to work as well. The options are no longer able to do that work, and just increasing volume is unable to help you there. So they had two hypotheses. One is that volatility is going to go up because options are helping stabilize the futures prices. Volatility went up. Secondly, options are also helping improve hedging effectiveness for the futures. There was a decline, very large one, in the hedge ratio. So both hypotheses confirmed. A major nuance there is that one of these was temporary. Volatility eventually came back down, but the hedging effectiveness stayed at a lower level for at least for several more years, as far as we know. They didn't go past 1939. Once the World War II starts, data is less available, at least for the London market. And yeah, markets can adapt to these kinds of bans or shocks somewhat. There may be structural problems caused by that. And there's some, of course, implications here for public policy. If you try to ban derivatives, there might be negative consequences from doing that. Shocking, yes. And there might be both short-term and long-term effects that could be different. Maybe some bad things will happen in the short term and we'll eventually work our way through them. Maybe there'll be some long-term negative things that happen. If we only look at short-term things and say only look at volatility, we might think, oh, well, yeah, there was kind of some unpleasantness for over a year or two, but we eventually worked things out. And if you ignored hedging, well, then you wouldn't see that there was a serious downside from doing this ban. Farmers, grain elevators, all these commercial users would have had worse risk management for quite some time, 48 years, while this ban is in effect. So, of course, the implication from this paper is look at everything. Don't just look at volatility. You should also look at things like the effects on hedge ratio. And honestly, it's hard to know all of the unintended consequences from doing something like banning derivatives. So, maybe be careful about doing that if you decide to ban derivatives. In terms of the paper itself, they have a pretty good diff and diff design. They got the London versus Chicago. It's the same commodities. They have the same weekly frequency. Definitely, there's no like arbitrage trading between these two markets because it's the 1930s. You can't really do that. The one most likely problem is that people have been talking about banning options for several decades at that point. So it's not really a true surprise, and they probably need to spend more time trying to basically show, people were thinking, sure, people are talking about this again, but it's not going to happen. It didn't happen the last 20 times people talked about it. That would be really helpful, I think, in kind of shoring up the argument that, well, it's been talked about so much that it's not going to happen. And the data set itself of the historical data from the 1930s is awesome. I don't think anyone has had this before, and they clearly think they can use this data set for other papers. They have some other papers using this data as well, and having this options and futures data for Chicago and London is great. It's actually a really great contribution for the field, regardless of their diff and diff design. And then it was also quite interesting to see that there was a short run and well as a long run kind of effects. Volatility and hedging ratio were not stabilizing at the same rate. And again, along with that diff and diff design, parallel trends is always a problem. They have that visual inspection. If they could get some way of formally testing it, would be even better. Of course, but that's not exactly easy to do. And as they say in the paper, there was this 1933 wheat manipulation, which triggered the desire to do the ban. That might have itself affected some things. They only started in 1934, so I don't know if they can get 1933. Maybe they can't. But if they could, seeing if there's volatility patterns before and after that wheat market manipulation attempt, that could also help them with that parallel trends. I think the real thing the paper needs to make it even better would be really improving the different and shoring up that argument for the diff and diff design. And that covers our last paper for our spring semester. Hope you enjoyed this paper or other papers in the series this semester. If you did, please comment, like, and or subscribe so others can find this video too. And I'll see you all in the fall with another series of papers.